Today, we're looking at an analysis arguing that Novo Nordisk at a 13.5x forward PE post-correction is a generational buy.
Right, especially with the oral Wegovy approval acting as the main catalyst.
The analysis nails the valuation dislocation. I mean, 13.5x for Novo versus 50x for Lilly? That's a stark contrast.
It really is, and tying it to that one key catalyst gives it a sharp focus. But, well, let's get into where we think it can be even stronger.
Okay, let's start with the risk section. The report makes a very decisive call. A strong buy.
It does. Very confident.
But then the risk is just summarized as medium, and the only specific point is supply chain execution is key.
And that feels a little light, doesn't it, for a thesis this ambitious?
Yeah, it almost feels too neat.
The assessment of risk, while acknowledged, requires expansion beyond simple supply chain execution to fully satisfy a skeptical financial mind examining a major pharmaceutical investment thesis.
I mean, you even mentioned later that the supply issue is being fixed with the Catalent acquisition, so you're almost solving the only risk you bring up.
Exactly. The weakness here is that the report identifies only one key operational risk for what you're calling a generational investment.
And it's missing the bigger picture.
It's missing the competitive threats, the commercial adoption questions around a new oral pill, all these things that are just inherent to this market right now. And that diminishes the analytical robustness.
That's a fair point. But you could argue, couldn't you, that NOVO basically owns the market right now. Lilly is there, sure, but the main problem has been supply. So if you solve supply...
You solve the current problem, yes, but you don't solve the institutional skepticism problem. That's the real bottleneck.
Ah, okay. I see where you're going.
So the suggestion is to integrate specific counterarguments, real bear case scenarios, that are directly tied to this new oral Wegovy catalyst.
You have to prove you've thought through the downsides.
You have to show you've anticipated what could stop this PE multiple from ever hitting that 20x target. That's what convinces the big money.
Okay, so give me a concrete example. What does that look like?
Well, for starters, you need to model the competition more directly. What happens if Eli Lilly's oral pill, orforglipron, what if it speeds up its trials?
Or gets better than expected data.
Right, or what if the market just decides oral Wegovy's side effect profile isn't as good as the injectables? That convenience factor only goes so far. You need to quantify that potential disruption.
And what about the business side? The pricing?
Absolutely. You could explore how that suggested $149 a month starter price might actually hurt overall margins.
Even though their gross margins are over 80% right now?
Exactly. That's a huge selling point. But if your new high-volume product has a permanently lower margin, you have to show the model can handle that pressure and still justify that 20x valuation.
I'm still a little hung up on the old news, though. The failed Alzheimer's trial? That happened, the stock tanked, it recovered. Do we really need to rehash it?
I think you do, because every institutional risk team is paid to look for ghosts like that.
For reasons why a stock might be structurally cheap.
Precisely. So the question is the market truly ignoring it now, or is it still a small drag on the multiple? You need to address it head on, even if it's just to dismiss it. It closes a loop, and it shows you've anticipated the bear's playbook.
Okay, that makes sense. It's about cleaning up any lingering skepticism.
Exactly.
So we've covered risk. Let's pivot back to that core idea, the valuation dislocation. The argument is that this 13.5x PE is just wrong, and the oral pill will force a re-rating to something like 20x.
Right, and building on that, to maximize impact, the analysis should more rigorously connect that catalyst, the pill approval, to the actual mechanics of how the PE multiple expands.
The bridge between those two ideas needs to be stronger.
It needs to be structural, grounded in math, not just assertion.
I see.
And this is a critical weakness right now. The report correctly says Novo is, quote, priced for zero growth. But then the jump to a 20x PE target, it feels like you're just saying it mean reverts.
It's a bit of a black box.
It is. The listener needs a much clearer, more quantifiable reason for why the market is going to completely re-rate this company's growth profile. It's not a utility stock, so why is it priced like one, and what specifically changes that?
So the problem isn't the 20x target itself, but the lack of a clear mathematical path to get there. It's an assertion, not a derivation.
You've nailed it. That's exactly right.
So what's the fix?
The suggestion is to focus the financial forecast on quantifying the immediate impact of this oral pill. Use the new low price point to justify the specific growth rates you need to push the PEG ratio past 1.0 and actually warrant that 20x multiple.
So you move the argument from the market should do this to the math demands this.
Yes, and let's get specific on the numbers. instead of just saying analysts are likely to revise 2026 EPS estimates up.
Which is a bit generic.
It is. Instead, you should forecast the exact EPS growth rate you'd need to make a 13.5x PE equal a PEG of 1.0. That's your baseline. Then you show how this new oral market at that low price point supports a growth rate even higher than that baseline.
And that's what justifies the target multiple, the 20x.
That's the justification a portfolio manager is looking for.
And you can tie this into the supply chain details you already have, the Catalan acquisition.
Oh, absolutely. Use those details to build a concrete capacity metric. How many millions of new patients can this new capacity serve in Q1 2026?
Specifically in that primary care market that the pill opens up.
Exactly. How does that hard number, that measurable capacity, directly underpin the growth rate you need for the multiple to expand?
Right. If you can show that the new capacity mandates, say, a 25% growth rate, and a 25% growth rate demands a 20x multiple, well, the argument becomes almost inescapable.
It removes the subjectivity entirely. It becomes a matter of logistics and math.
Okay, I can see the urgency in this analysis. I mean, the passion really comes through. Golden opportunity, as the title says.
It does.
But let's talk about that for our final point, the tone, the style. Sometimes the delivery can work against the core idea.
The highly emotional and hyperbolic language used to convey urgency, while engaging, risks inadvertently diminishing the credibility of the strong underlying financial and technical metrics presented.
It feels like the data is already shouting, but the language is shouting on top of it.
Right, and that's the weakness. The frequent use of phrases like bloodbath finally over, or insane discount, or pounding the table.
It leans a little into market hype.
It does, and paradoxically, that can overshadow the really meticulous data you've presented. The 80% margins, the sub 1.0 PEG. A sophisticated reader might start to feel like they're being sold something aggressively, and that raises their defenses.
But isn't there a time and place for that? I mean, when you spot a dislocation this big, don't you sometimes need to shout to get people's attention?
You do need to convey urgency, I agree, but that urgency has to come directly from the data itself.
Let the numbers do the shouting.
Exactly. The suggestion is to maintain that urgency by replacing the generalized hyperbole with language that's strictly rooted in specific technical or fundamental findings. Let the objective data be the powerful salesperson here.
Okay, walk me through that. How would you rephrase it?
Let's take the technical signal that you said confirmed the bottom. Instead of, if you blinked, you missed the bottom.
Which is a great line, but maybe a bit much.
It's punchy, but maybe not for this audience. You could focus on the specifics. The clear breakaway gap today, jumping from 303 to 320 DKK, confirms overwhelming institutional buying volume. This signals the market has definitively rejected the 52-week low.
That's a powerful shift. It sounds more like an observation of market mechanics, not just speculative excitement. That's something someone can act on.
Right. And let's do the same for the valuation. Instead of insane discount, what if you framed it as a durable competitive moat mispricing?
Ooh, I like that.
It's precise, it highlights the market's fundamental error, it forces the reader to think, why is a company with unique IP and 80% margins being valued like a utility stock?
A utility stock with almost no growth prospects?
Exactly. The term durable competitive moat mispricing just elevates the entire argument. It summarizes the whole thesis without having to resort to hype. It forces the reader to contend with the data, not just your enthusiasm.
I see. That makes perfect sense. Let the strength of the numbers carry the emotional weight.
That's the goal. Let the data talk.
Okay, this has been incredibly helpful.